Welcome to House Lux Estate, where financial literacy is our mantra and your wealth is our mission. As your loyal guide through the labyrinth of real estate and investment, we aim to educate and empower you. Our channel is your go-to sanctuary for all things related to wealth creation and financial independence. So don't forget to hit that subscribe button to stay updated with our latest content. Today, we delve into the fascinating world of stock investing. Buckle up! Imagine owning a piece of a successful company. That's exactly what buying stocks is all about. Let's dive a little deeper. When you purchase a stock, you're essentially buying a small fraction of a company. This makes you a shareholder, granting you part ownership in that corporation. The more shares you own, the larger your slice of the company. Now, the value of these stocks or shares is not set in stone. Instead, it fluctuates based on various factors, primarily the company's performance. Think of it as a seesaw. When a company performs well, its stock value rises. Conversely, when a company underperforms or experiences financial difficulty, its stock value may fall. This is because the value of a company's stock is a reflection of its perceived worth by investors. If the company is seen as successful and profitable with a promising future, more people will want to buy its stocks. This increased demand can drive up the stock's price. On the other hand, if the company is viewed as struggling or risky, demand for its stocks may decrease, causing the stock's price to drop. But remember, stock prices are also influenced by overall market trends and economic conditions. So it's not just about how well the individual company is doing, it's also about how the economy is performing, investor sentiment, and a myriad of other factors. What's more, as a shareholder, you may be entitled to a portion of the company's profits, usually distributed in the form of dividends. You might also have the right to vote on important company decisions. So owning stocks is not just about potential financial gain, but also about having a say in the company's future direction. However, it's worth noting that investing in stocks carries risk. The very factors that can cause stock prices to rise can also cause them to fall. That's why it's crucial to research and understand the companies you invest in and to have a diversified portfolio. Now that you know what stocks are, let's move on to why you should consider investing in them. Stock investing, when done right, can be a powerful tool to grow your wealth. It's like planting a seed and nurturing it over time. As it grows, so does your investment. Let's talk about the potential for high returns. Stocks have historically outperformed other investment types over the long term. Yes, the market can be volatile, and there may be periods of downturns, but over time, the trajectory has generally been upward. Think about it as a roller coaster ride with an upward trend. It's thrilling, isn't it? Now, let's move on to the concept of compound interest, often referred to as the eighth wonder of the world by investors. When you reinvest the earnings from your stocks, you're not just earning interest on your initial investment, but also on the returns you've already accumulated. It's like a snowball effect. Your wealth grows exponentially, not just linearly. But remember, with great power comes great responsibility. And in the world of stock investing, that responsibility takes the form of diversification. Diversifying your investments across various stocks, sectors, or even countries can help manage risk. It's like not putting all your eggs in one basket. If one stock or sector doesn't perform well, others might, balancing your overall portfolio. And finally, let's talk about the importance of long-term investing. Rome wasn't built in a day, and neither will your stock portfolio. It's not about getting rich quick. It's about steadily building your wealth over time. Patience, they say, is a virtue, and in the world of stock investing, it's a necessity. Stock investing can seem intimidating at first, but once you understand the basics, it becomes a lot less daunting. It's like learning to ride a bike. Once you get the hang of it, the journey becomes less about the ride and more about the destination. And in the case of stock investing, that destination is financial freedom. So buckle up and enjoy the ride. So, you've decided to dip your toes in the stock investing pool. But where do you start? Well, first and foremost, you need to conduct some solid research. The stock market isn't a game of chance. It's a game of knowledge. You're not betting on horses. You're investing in businesses. That's why understanding the company you're investing in is crucial. Learn about their financial health, competitive position, and industry trends. Look at their earnings reports, read news articles about them, and consider their future prospects. Next, let's talk about setting a budget. The old adage, "Don't put all your eggs in one basket," rings true here. Diversifying your investments can help manage risk. But how much should you invest? A golden rule to follow is never invest more than you can afford to lose. This is not to say that you will lose money, but it's always better to be safe than sorry. Also, it's important to remember that investing isn't a get-rich-quick scheme. It's a long-term commitment. The stock market can be volatile, with prices fluctuating daily. Don't let these short-term movements deter you. Instead, focus on the long-term growth potential of your investments. And don't make decisions based on emotions. Fear and greed can lead to impulsive decisions like buying high out of excitement or selling low out of fear. Instead, make informed decisions based on your research and stick to your investment plan. To help you with this, consider setting up an automatic investment plan. This way, you invest a set amount of money at regular intervals, regardless of the price. This strategy, known as dollar cost averaging, can help mitigate the impact of market volatility. Finally, it's essential to continuously learn and grow as an investor. Read books, listen to podcasts, attend webinars, and engage in investor communities. The more you know, the better decisions you'll make. Remember, the key to successful investing is patience and consistency. Stay the course, and over time, you'll see the power of stock investing. While stock investing can be rewarding, it's also rife with potential pitfalls. Let's navigate through some of these common missteps that investors often fall prey to. First up, investing based on hot tips. It's easy to get swept up in the buzz around a particular stock, especially when everyone seems to be talking about it. But remember, investing isn't a game of follow the leader. It's about making informed decisions based on solid research. So next time you hear about the next big thing, pause, do your homework, and then decide if it's worth your investment. Next, let's talk about diversification, or rather, the lack of it. When it comes to investing, it's never wise to put all your eggs in one basket. Why? Because if that one stock crashes, so does your entire investment. Diversifying your portfolio across different sectors and types of investments can help mitigate risk and create a well-balanced portfolio. So don't just stick to what you know, explore, learn, and diversify. Now, onto a mistake that's often overlooked yet incredibly crucial: letting emotions drive investment decisions. Investing can be an emotional roller coaster. The thrill when a stock soars, the panic when it dips. But here's the thing: successful investing requires a level head. It's about sticking to your investment strategy regardless of the market's ups and downs. So the next time your favorite stock takes a hit and your instinct screams sell, take a deep breath, review your strategy, and make a rational decision. And finally, remember that investing is not a get-rich-quick scheme. It's a long-term game that requires patience and persistence. Don't expect instant results. Instead, focus on building a solid portfolio that can weather market fluctuations and provide steady returns over time. Avoiding these mistakes can set you on the path to successful stock investing. So keep these pitfalls in mind, learn from them, and let them guide your investment journey. After all, every misstep is a stepping stone to becoming a smarter investor. Investing in stocks is a journey, and every journey begins with a single step. Just like we've navigated through this conversation today, it's critical to remember the essential points we've covered. Firstly, we unpacked the concept of stocks, ownership units of a company that you can buy and sell. We discovered the power of stock investing, how it can be a vehicle to wealth accumulation, financial security, and even freedom. Remember, the power lies not just in the act of investing, but in the consistent, strategic, and informed decisions you make. We then delved into getting started, emphasizing the importance of research, understanding your risk tolerance, and setting clear, achievable investment goals. It's not a sprint, but a marathon, so patience and persistence are your friends. Finally, we touched on common mistakes to avoid: overtrading, letting emotions rule your decisions, neglecting diversification, and chasing hot tips without due diligence can derail your investment journey. Always keep these pitfalls in mind and steer clear so your journey is smooth and fruitful. Remember, the world of stock investing is vast and exciting. It's filled with opportunities, but equally it demands respect and understanding. Your financial future is in your hands, so take that first step, continue learning, and make informed decisions. Thank you for joining us today on House Lux Estate. Don't forget to hit that subscribe button for more investment and real estate insights. Here's to your financial success.